Okay, a bit of a soft start to the trading day. Let's get some perspective on where the markets could be headed. Brenda O'Connor-Juanez, Senior Vice President and Financial Advisor at UBS, is joining us. Brenda, nice to have you back. And we were talking earlier about investors trying to make sense of the latest economic data this week, what that means for interest rate policy, and I guess the other piece of context is we had that really strong start to the year for equities.
Right, and thanks for having me back, John. Now, look, we are 6 weeks into the year, and to say that markets have had a good start is an understatement. Markets are flying, and indices that were down 20 or 30% last year are up, in some cases, 15%. So, of course, this is a welcome reprieve for investors. But, I don't think we're quite out of the woods yet. Yes, there is some good data coming out. You can see that in growth. Think about China's COVID pivot. We can see that in inflation. Again, we saw a little bit of this yesterday. There's also been some positive commentary coming out of the Fed. Again, we don't think that this is a sustainable rally just yet for a number of reasons, including earnings and valuations we can talk about in more detail. But at this point, we're being conservative in terms of our positioning for clients.
Well, yeah, sure. Absolutely. We love to talk. So on the earnings front, then is your concern just that maybe some of the expectations right now on Wall Street are too rosy in the face of this economic uncertainty?
Right. So here's my thoughts on earnings. So, earnings are, we are basically done Q4. And on the whole, earnings were below forecast by about 1%. So our view on earnings is that they're going to be down 3 to 4% this year. And seems to be a disconnect between earnings and valuations. So when you look at valuations, we're trading at 18 times forward PEs on the S&P, and you don't usually see 18 times unless you are expecting low interest rates or aggressive earnings growth, neither of which we expect right now. And so we're still holding our target on the S&P at 4,000 for the end of the year. And again, positioning is really going to matter as a result.
And so if valuations to you maybe look a bit stretched in the face of some of that macro reality, how do you decide where you want to have equity exposure?
Right. And let me say this, how you navigate the next few months here does depend on your starting point. And there are really two scenarios here. So number one, if you are sitting in cash, forward-looking long-term equity expectations are now between 8 and 10%. That is attractive. So for these investors, of course, you want to hold an allocation to high yielding cash or cash alternatives, but I would be stepping into the market here, building up equity exposure. You can start non-US equities, which are trading at lower valuations. Number two, if you are fully invested and you have your full allocation to equities, I would be tilting to more defensives and value names, sectors like consumer staples, healthcare. We've talked about this before, but essentially these are the sectors that will be able to navigate through volatility, and these are the sectors that are going to be able to deliver resilient earnings.
And then the other thing, we're showing our television audience just a few of your portfolio strategy ideas. You've outlined a couple of them. Small caps is an area that you think could be an interesting trade.
Right. And I will say this about small caps. So you have to be willing to look through short-term volatility. But I think a trade in small caps could look really good, especially 12 to 24 months from now. And here's why. Again, it's a valuation story. So small caps on a valuation basis are trading at a steep discount to large caps. Small cap indices are trading at 14 times versus the S&P, which is over 18 times. Again, this is above the 10-year average. The second point here is that there's an interesting relationship between small caps and the yield curve. And so more specifically, when that yield curve does steepen, there is a positive relationship. And you can see this in outperformance of small caps 12 to 15 months later. And so our view is as that 2-year comes in, this could be a really interesting place to allocate money.
And just before I let you go, given everything you've said, Brenda, it does sound like arguably there is an increasing risk for investors in sitting in cash too long, if that's where most of their money is right now, even with some of this lingering uncertainty?
Right. And listen, we haven't seen cash rates or short-term fixed income rates at these levels in a long time. But then it comes back to the inflation story and which asset classes are beating inflation on a long-term basis. We saw yesterday's inflation number. Yes, it did come down lower than expected, but we're still at, inflation in the sixes. So you really want to be thinking as a long-term investor about allocating to asset classes that are going to generate real returns after inflation. And as good as cash looks now, it's not as good as some of the other long-term riskier asset classes.